Today, guys, I'm going to talk about how I'm currently scaling my rental portfolio in Florida and in Puerto Rico. I'm going to give you a couple of ways that you can jump on board, jump on the train, and start doing this whether you're a seasoned pro or a brand new beginner who's never done it before. And don't worry, with both of these strategies, you don't need a ton of money to do it. And even if you don't have any money at all, we're going to address how you can find great deals and then get the deals funded so that you have rental properties in your portfolio and no money out of your own pocket. My two strategies that I want to talk to you about today are buying properties subject to and seller financing. Now, if you're watching a YouTube video about becoming a real estate investor in 2024, you've very likely already come across these two terms, and I want to tell you why. Because for years and years, both of these methods have been around, but they've never been more prevalent and more prominent for real estate investors than they are right now. So very recently, just a couple of years ago, interest rates were at an all-time low, like practically free. Things were less than 3%, just ridiculously low interest rates. And those people that have those mortgages on their houses that are trying to sell now in markets where they don't have any equity or it's not moving fast, maybe they've gotten themselves in some trouble because of divorce or because of bankruptcy, who knows why they're in trouble, but they still have these mortgages on these properties at these really, really low rates. And the good news for you is that these mortgages have been out there for a couple of years. So when you can buy a property subject to, you get to take over that person's mortgage without ever assuming it, without ever going to the bank, and without ever qualifying. There's some risk. We'll get into that, but there's a lot of benefit to this. The biggest benefit, obviously, is being able to come into a property where somebody's borrowed the money at these really low rates, buy it, start paying the bank directly, put a renter in there, let the renter pay off your mortgage, so you don't have to do these high margin deals. These can be very low margin deals. They're really easy for real estate investors who don't have a lot of money to get into. So for years and years, the best way to buy something was always to buy it cash at the lowest price possible. But right now, a really good way is to take over someone else's already existing mortgage, and we call that subject to. Let me explain again real quick what subject to is. It's a real estate investing strategy where you're taking over someone else's loan. So they've got the really good loan, the less than, let's say, 5% interest rate, and they can't sell the property for whatever reason, and you come in and you negotiate a price with them where you give them a little bit of cash, they deed you the property, and you start making the payment directly to the bank. No assumption necessary, no credit necessary, and obviously when you're doing this kind of investing, it's very little money out of pocket because there's not a ton of equity in these deals. But generally speaking, the houses are going to be in pretty good shape. The banks were lending on them just a couple of years ago. So unless the people have just beaten the crap out of the house over the last 2 years, the house is still going to be in good condition. And as you move out the seller, you can move in a renter. And oftentimes your renter is going to come in and he's going to be able to pay a higher rental rate than you're paying to the bank. So let me give you a real life example of a sub-2 deal that I just did to build my real estate portfolio in Orlando, Florida. We found a house where the guy had actually passed away and we took over the mortgage. It was about $20,000 in arrears. It was in foreclosure, and the lady who was inheriting it didn't have the money to bring it out of foreclosure. So she inherited it. We helped her take it through probate. I brought $20,000 to the table and I brought the loan current with the bank. I then gave the lady another $20,000. So I had like $40,000 plus the cost of probate and closing costs. It was about $50K of my own cash all in on this rental property that I bought in Altamont Springs, Florida, a 3-bedroom, 2-bath house. It was in very good condition. The mortgage that I took over was at like 4 or 4.5%. I don't remember exactly, but a very, very low mortgage rate. And the loan had been in existence for like 3 to 5 years. So a 30-year amortized fixed rate loan that's been in existence for 4 or 5 years. So it's just really, really magical. I get to take advantage of that low interest rate. I'm paying the bank directly. I have very little money out of pocket, only 50 grand. We rented it immediately for $1,900 a month. And our all-in principal, interest, and taxes insurance on this particular deal was $900 a month. So I've got $1,000 a month, give or take $1,100 if everything goes well on a good month. But factoring in vacancies and some repairs, I've got roughly $800 to $1,000 a month of positive cash flow from day one with almost no renovations whatsoever. It's a brilliant way to be able to add to our rental portfolio. We're about to close on another one that looks a lot like that. It's a little bit cheaper deal in Daytona Beach, Florida, where we're taking over a loan loan for like $115,000, and it's basically almost the same math. I'm going to bring $15,000 to bring it current. I'm going to give the guy who's selling it, he's not inherited it, he just is moving out. I'm going to give him about $15,000. So I'm going to have $30,000 in it, and I'm going to need to go in and do some minor repairs to get the property up to where it will cash flow. I'll be able to rent that property out for like $1,650 a month, and the monthly mortgage payment, principal, interest, taxes, and insurance is like $750 a month. So again, I'm going to have $30,000 or $40,000 out, and I'm going to be bringing in a positive cash flow of about $1,000 a month. And then, by the way, I'm going to be having a renter who moves into the property and pays for the property for me. And I don't have to make a ton of money on these. Like, these things are cash flowing really well. But even if I wasn't making very much cash flow at all, if it was perhaps less money out of pocket and no cash flow, I'd be happy to do those deals too. So you can do very tight margin deals, very little money out of pocket, and you can get yourself a rental portfolio that has cash flow, is getting appreciation. You can depreciate. You get all of the joys of ownership, all of the benefits and the tax breaks, all of the stuff that you get from being a landlord. And guys, I tell this all the time, if you can buy something today and hang on to it, have it cash flow for the next 5, 6, 8, 9, 10 years, you're going to hit a grand slam home run every single time. On the two deals that I'm talking about, both of them have some equity. So we're buying them even with some equity. And then over time, that equity is just going to soar, and the renter's going to pay down the mortgage. This is a brilliant way for us to increase our rental portfolio. Hopefully, you're picking up on what these benefits are. So the benefits to buying subject to, you don't have to go to the bank and qualify. You don't have to have great credit. You don't have to get the house appraised. You get to move so fast and take advantage of something where somebody's already paid for that, and you don't have to pay for it. You're getting it subject to what they've already done a couple of years ago. On these deals, when you're taking these over, you have very low risk. Of course, there is something called a due on sale clause, and you need to be aware of it, but it's not the boogeyman that you need to be afraid of. As long as you're making the payment to the bank every single month, the bank is generally speaking not going to call the loan due, even though they have the right to do it. If they were to call the loan due, then you would need to be able to go and find other financing or sell the property. So just keep that in mind. But having done this for 25 years, we've done dozens of these. I'm not the beat-all, end-all, Pace Morby expert of this, but I've done it enough. I've never had one of these loans called due, and we've been doing them for a long period of time. So in today's market, again, as long as you're making the payment to the bank's not going to want to foreclose on you. They just want to get paid. So how do you find these people that will actually sell to you subject to? A lot of times you're going to find them when they're already in distress. I like to look at the foreclosure list, look at people who are already behind on their payment. You could call it pre-foreclosure, because in the States, if the bank hasn't foreclosed on you at the foreclosure sale, then generally speaking, the homeowner still owns the property and you're still negotiating with the homeowner. So you want to find people who are in distress, who are going to lose the property to the bank. That's one way that you can find people. The other thing that you can do is simply go on Zillow and find the stuff that's been on Zillow for a long period of time. So if you're like me in a market like Orlando, Florida, where properties generally are selling in 30, 60, or 90 days, and you see something that's been on the market for the longer part of that time, 90 days, maybe 120 days or longer, then you have a pretty good idea that they probably don't have a ton of equity. And so if that's true, you can offer them close to their asking price and actually give them money when they don't have a ton of equity. How does that work? So let's say someone's asking $300,000 for their property, and they owe $280,000. And so they've had it on the market for a long period of time, and everybody's offering them $250,000, $260,000, even $280,000, which would mean that after closing costs and paying their realtor, the seller would have to come to the table with money, with cash out of pocket. And so they're just unable to take those deals. But you can come in, buy it subject to their loan, and actually put some cash in their pocket, because you don't have to go get a new mortgage. You don't have to bring all of the cash to the table. So as long as you can buy something that cash flows, has a little bit more from the rents coming in than going out to the interest rate or to the mortgage payment, then that's a good deal. And guys, these can be low margin deals. You don't have to make a ton of money on these things. You want to get something that probably at least bare minimum breaks even. When you're negotiating the terms on a subject to deal, you want to look at what the people are paying on the mortgage. You want to get the bank statements and see what they owe on a monthly basis. Does it cover principal and interest, taxes and insurance? If it does, that's really good. If it doesn't, then you need to factor in what are the taxes and then the insurance going to cost you as well. You want to make sure that your rental income is going to be at least even or slightly higher than, and I would actually suggest slightly higher than what's going out to the bank, so that you have a safe deal. Because these are tight deals, there's not a ton of equity in them. You want to make sure that you're going to break even at least. You're going to be able to make money in other ways. You're going to be able to make money through appreciation. Rents are going to go up over time. You're going to be able to depreciate the asset. So if you're making money somewhere else, you'll be able to save on taxes. There's a lot of joys to owning real estate. And if you own it for a really long time and let someone else pay off that mortgage over the next 10 or 15 years, you're going to hit a grand slam home run every single time. So buying rental real estate and owning it for the long haul, that's how you hit these grand slams every single time.